Real life, of course, is going to be more complicated than what we're going to see in examples in slides and textbooks. And so we have to consider a few of those that the author goes through. First issue, equity can come from retained earnings or from a new investment. If we're raising money in the market, we're going to be looking really at what equity investors are going to be demanding from a return on a new equity investment. But managers might also be reinvesting profit that they've kept within the company. Profit that's been stored away in retained earnings can also be invested in the company. And these are going to have two slightly different rates of return. The difference largely comes from the fact that new issues of stock and bonds come with flotation costs and price adjustments in order to incent the buyers to buy this new issue of stock, and these things have to be factored in. When we're factoring in the costs of flotation, what this is going to do is it's going to raise the amount of money that the company has to raise, has to borrow or get from investors, and this is going to change the rate of return that they're having to pay. When we're talking about retained earnings, we don't have to worry about flotation costs. We just have to worry about what the cost of capital is for that money, which should otherwise be returned to the investors. The other complication that we run into is this. Growth rates are rarely stated, and so we may have to compute them. This is going to be a skill that we're going to be using in the next several sections of this course also. So we're going to go through how to compute growth rates from a set of numbers. Let's take a look first of all at the cost of debt with flotation costs. The ABC company is in the 40% tax bracket, and they can sell 15-year bonds with a $1,000 par or $1,000 face value, paying an annual interest of 12%. Market rates are slightly below that for bonds of this rating, so bonds will sell for $1,100. To issue the bonds, ABC will have flotation costs of $30 per bond. We need to find KD. Now in this case, the information that we've been given is annual. This company is going to sell 15-year bonds, which are going to pay annual interest of 12%. So we've got 15 annual periods. We're going to be solving for I, but the result we're going to be getting is going to be an annual number. And the payment that we're looking at is a 12% of the face value, but it's an annual cash outflow. Our present value, or our price, is going to be the expected proceeds less the flotation costs. So the cash inflow that the company is going to get from this is going to be the price the investors are willing to pay for these bonds, $1,100. But we're going to have to take those flotation costs out of there because the company isn't going to receive those. This is going to go to the investment banks, the lawyers, and the other parties who are putting these bonds together. So the money that's actually going to be realized from the company is going to be $1,070. That's going to be the PV that we put into our problem. Our face value is still going to be the $1,000 outflow. That number doesn't change. That's written into the terms of the bond, and that's what's going to be paid out to the investors when the bonds mature. So when we solve for this set of inputs, we come up with I equal to 11.0252. So our YTM, since that's an annual number, is the same thing. It's 11.03%. That's our before-tax cost of debt. If we wanted to know the after-tax cost of debt, we'd take that and multiply it by the tax shield, which in this case would be 1 minus 40%. 11.03 times 1 minus 40% would be the same thing as 11.03 times 60%, which would give us 6.62%. In the homework problems like this, when you see that the tax bracket is stated with a cost of debt problem, that's a hint from the author that he is going to want the after-tax cost of debt. You're going to need to compute the before-tax cost of debt first, but then figure out the after-tax cost of debt and figure out from the homework which one of these is the right one to enter. If one of them isn't right, the other one should be. If neither of them works for the homework system, you've probably made an error in your computation somewhere, possibly in what you're doing with the expected flotation costs. The cost of preferred stock with flotation costs is going to be a similar sort of a proposition. We're going to take the net proceeds that are going to be collected and we're going to subtract the flotation costs out of that to see how much is the company actually realizing from it. So XYZ company is issuing preferred stock with an 8% dividend and a $120 par value. The shares will sell for $129.60 and have flotation costs of $7.20 per share. What is the cost of preferred equity? The par value on the stock is $120. The dividend paid is going to be 8% of that par value, which is $9.60. The selling price is $129.60. The flotation costs are going to be $7.20, so the net proceeds the company will realize is going to be $122.40. The cost of capital, which the company is going to have to bear for this preferred equity, is going to be the ratio of the dividend they're going to have to pay divided by the amount they're going to realize from each share. Now, this is an important distinction to make. When we're figuring out the required rate of return which the investors are going to demand, they're going to be demanding it based on the amount that they pay. They're going to be demanding it based on the $129.60. But now we're looking at this from a different point of view. We're looking at this preferred stock from the point of view of the company issuing it. And for that reason, we need to think about the rate of return that they are going to have to bear, the return that they're going to have to get on their business project backed by this money, is going to have to be equal to the dividend they have to pay out divided by the money that they received. So for that reason, our cost of preferred equity is going to be the $9.60 dividend divided by the net proceeds that they realize, the $122.40, which gives us 7.84% cost of preferred equity. Cost of common equity, again, is going to have a similar sort of a situation, but we might have to figure out what our historic dividends per share are and what the growth rate is that's implied for that. So here's an example of that sort of a problem. ABC Company is considering a seasoned equity offering called an SEO. Their stock currently sells for $48.22, but new shares will be underpriced by $1 and have a $2.86 share in flotation costs. The planned dividend per share is $1.45 for the coming year, and they expect the growth of dividends to follow the same average growth it has for the past 5 years. Historic annual dividends are as shown. What is the cost of equity for this seasoned equity offering? Well, we know we're going to wind up with the cost of equity equal to the expected dividend divided by the price per share plus the rate of growth, but we don't know what the rate of growth is yet. Let's talk about that first. The historic dividend per share, DPS stands for dividend per share, is as shown. And if we're looking at that growth, what we can do is figure out exactly what we're seeing happening over a period of time and seeing what the compound annual growth rate is. This is not going to be a simple function or an average amount of growth that we're seeing, but really the result of compounding. Investors are seeing a compound return on their investment, so we need to find what the compounding base is. If we're looking at the end point and the start point, the end point on the dividends was $3.10, and the start point was $2.12. And we have 5 years during which this has happened. The first year was 2008 with $2.12. Then we had 2009, 2010, 2011, and 2012. So during that time, the actions of compounding and growth have changed that dividend from a start point of $2.12 to an end point of $3.10. Within that 5-year sample, we've only seen 4 years worth of change. Remember, we started with 212, and then the first year of change brought us to 230. The second year of change brought us to 260. The third year of change brought us to $2.92. And the fourth year of change brought us to $3.10. So what we really want to do is this. We want to take the fourth root of that growth. We want to see what was the ratio of the end amount versus the starting amount, and then take the fourth root of that because we've seen 4 years of compounding in that 5-year sample. Now, when I'm taking the fourth root of something, this would be like drawing a radical and putting a little 4 next to it, but on graphing calculators, it's much easier to use a fraction, and the little caret, that little triangular shaped thing, is called a caret, and that's what you use on your graphing calculator to raise something to a certain power. So if I want the fourth root of something, I'm going to raise that number to the 1/4 power. Now the ratio showing the amount of change was $3.10 divided by $2.12, so it's 1.46. When I raise that result to the 1/4 power, because I had 4 years of compounding, the result is 1.0997, which means that the growth factor is that amount minus 1. My compound annual growth rate is going to be 9.97%. So back to our problem. ABC company with their SEO and their prices and their information, now we know what the growth rate is. The growth rate was 9.97%. But the next question is, what should we use for the price? Now, there are a couple of factors in here. One is that the new shares are underpriced by $1, and the other is that they have a $2.86 per share in flotation costs. In other words, the company is going to have to give a little bit of a discount on these shares in order to entice investors to buy additional shares. And the cost of floating those shares is going to cost the company some money. So here's what we're going to do about the price. We're going to find the net proceeds, which is going to be the expected selling price, $48.22, adjusted for the underpricing of $1 and adjusted for the flotation costs the company has to bear. So the net proceeds are going to be $48.22 minus $1 minus $2.86, or $44.36. Now when we're figuring out the cost of equity for the seasoned equity offering, we can take the $1.45 dividend expected. We're going to take the $44.36 and we're going to then add our growth rate back onto that. We come up with a cost of equity of 13.24 cents for a new issue. What if they had used retained earnings instead of issuing new stock? What if they hadn't gone out to the market? What if they didn't have the underpricing issue? What if they didn't have the flotation costs? What if they just relied on the profit that they had stored up in the company so far? We'd be looking at the dividend being the same. We're still expecting about 9.97% growth in their dividends, and we'd be looking at their current market price of $48.22. When we do the math on that, KE turns out to be 12.98%. Why is the cost of equity then higher for new stock than for retained earnings? What this implies is that because it has a higher rate of return, that it's viewed as being riskier than the use of retained earnings. But is that really true? What a new equity issuing from a company suggests is that that company isn't able to grow within the resources that it's able to generate from its existing businesses. Now, if a company needs an infusion of outside money to grow, that does suggest that they are risky, and therefore it should hold some sort of a higher rate of return. This is the reason that that underpricing strategy is used to incent investors to buy this new issue of stock. We're going to sell it at a $1 discount over what the existing share price is. That's going to drive the rate of return up all by itself. In addition to that, we've got a certain amount of effect from the flotation costs per share, so that $2.86 is also going to drive up the required rate of return for a new issue over retained earnings. Now, what would happen to a company if it always issued new stock instead of funding growth from retained earnings? What would happen gradually is this. Over time, the required rate of return for their equity would get higher and higher and higher. And as the required rate of return gets higher and higher, we're also going to see more and more risk being attached to that company. Investors are going to see this company being riskier and riskier and riskier because they have to keep going back to the capital market to raise money.